for a dozen years plus, with highs at the same level. Every time it goes up to like over 8%, it gets knocked back down a bit. It doesn't go back to that 4% level. No, it didn't. It left that alone, but still lived in a range. You're now with 1 day left in the month. If you close tomorrow where the spread is right now, you're going to break out of that massive spread range. Similar to that line we broke out of, where gold broke out over the S&P, okay, November, and shot up $1,000. Even in the pullback, it's up $1,000 in price. Not just beating the S&P, but also a surge in gold. Well, here the gold and silver miners relative to gold are saying, I'm back. I'm reborn.
Yeah.
And I'm still at 8.7% of the price of gold compared to lows that were 17, 18%. In other words, when you look at that chart, if you broke out of that base and ran up to the bottom end of the multi-decade prior range of reality,
right,
you'd more than double the current relative value of the gold miners to gold. So wake up. Something's just beginning. You don't break that spread out and top the market. Okay. Very seldom. It's too peculiar to be, an accident. That's not our expertise at MSA. We analyze markets via their momentum, structural behavior, technically, in other words. But these events are just bizarre. And when they occur is bizarre. And how limited it is. In other words, it wasn't the whole CME went down,
Right.
It's just silver, gold, and natural gas too. So we can't just say it was, well, they're manipulating silver because natural gas got shut down too. But anyway, any attempt by any force, whether government, brokerage firms, whatever, to restrain a market from doing what it otherwise would do in reality, merely compresses the explosive effect. Whereas if you hold something back and it should have been there, but you're keeping it back, when you finally crumble, as the enemy overruns you, okay? Yeah, it's probably even more compressed then with explosive behavior, in the case of silver, upside, explosive behavior, than it would otherwise be. Markets make errors. Markets aren't always rational. It's a false assumption. And whenever markets do make an error, we see this in bubble stock market tops, for example, where the market gets overpriced for too long, like the .com top, let's say. And when it unleashes itself even more than it probably should. If one error goes to another. Well, silver has been irrationally in a range for 50 years. From $4 to 50 to $4 to 50, and if you looked during that same period, 1970s through 2011 peak in silver when it hit 50 again until now, just recently, a couple months ago, broke through that. No other market's been restrained like that. Copper hasn't. Copper lived in a range from 50 cents to $1.50 a pound during multiple decades, 70s, 80s, 90s, 2000. And in the late 2005, it said, no more. Boom. It went to $4.50 in a matter of a couple quarters from a zone that on average was $1. Silver's still in its 50-year range, though. Lead, another exciting market. 2007 did the same thing. It had been in a range for many decades and suddenly quadrupled basically in price in a matter of a couple of quarters. And once it did, it lived in a new reality of price level compared to that old reality. Well, silver on a net price basis, if you're just a stupid price chart looker, okay, you got a breakout a couple months ago, getting above 50. Okay, fine. First thing it did is go to 122. Bam. Oh, more than doubled the range. The range was what, $4 to 50, $4 to 50.
Yeah.
It was like a $45 range, let's call it. We'll add $45 to 50, and it says, well, the swing objective would be 95, right? Thickness of the range added to it, the orthodox. Yeah. Well, it went past that. So that notion is no good anymore. So silver said, no, I'm not going to be confined by old rules. If silver does what copper did in 2005-06, or what lead did in 2007, or what gold has done repeatedly at each of its bull market peaks, it goes way beyond the old peak. We project and have projected for months now that when this thing unleashes to a new reality we call silver, it's probably going to be, $300 to $500. And only then would, I think Eric Sprott pointed this out in an interview he did some months ago, that if you factored in just the decay in the money unit, and there was the increase in the quantity of the money unit, M2, and factored that back to 1980 or 2011, silver would well be in the hundreds just to get even to those equivalent price levels and reflect the decay in the real buying power of the dollar. And the fact that there might be entities that try to restrain this process, and obviously it hasn't been working. We're not still in the 50s again, okay? They only accelerate it, and they create these boom effects. So it wouldn't shock me somewhere down the road here in the next couple months even to see something like, a couple $10 days in silver or $20 days on the upside. Bam, bam, bam. Where it's just gas, okay? While it seeks its new reality. These things are compression effects, and they're wrong. In other words, they're trying to keep reality from happening. And ultimately, once the market unleashes itself, as it has, even on a net price basis, it said, I'm not going to live in that old range again. Okay. Well, our momentum work said that before that even occurred in price. Momentum said, you're accelerating. Right. In fact, June of last year, silver was coming back up to 35 again. It had already been there a couple times in late 24 and early 25, just above 35. And it dropped hard into April, if you recall, last year. It came roaring back up. And when it was about 34 plus, we said, okay, this time it's different. You're going to accelerate. And sure enough, we went from 35, bam, up to over 50. And then something else happened. And it's a metric we're watching that most people aren't, but we see it as a dynamite metric. And I've sent you some charts that make this point. A lot of people like to look at a price chart, and obviously if you just look back a year or two or three and what's happened then, you see this verticality and you think, oh my gosh, I can't get in that. That's right. I missed it. It's going to crash, et cetera, without looking at the context of the longer term reality that it has existed for more than a half a century. Okay. But momentum said, no, it's over. We're coming out of here. Okay. And then price joined. Usually it's lagged to its own momentum. Okay, fine. But, and so that's our main analysis, is the momentum analysis of the price action. And when we plot it, we get different visual view of the trend structures that you might see on a price chart, like the ceiling going back 50 years on price at $50, $50. Okay. Well, on momentum, you have similar structures, but they broke out earlier. Okay. We're plotting price in relation to a moving average, and we're oscillating it. So it's not just like overlaying a moving average on a price chart. Everybody does that. But where is it in relation to that average? And you create an oscillator, and it gives you a different visual picture sometimes. And usually it will lead price. Okay, forget that. We stepped away from that a bit, and we also looked at relative performance of this versus that. For example, some big things happened on relative performance in the last 3 or 4 months. For example, the issue is for an investor, what's a better place to be? It's always the question. And it's always, well, within the S&P, where's the best place to be? But how about thinking beyond that? Maybe gold is a better place to be than the S&P, or gold and related things. Okay. And if you go back after that 2011 peak in gold collapsed in price down to $1,900 down to $1,050, and its relative performance to the S&P. And this is the first chart that is being put up. It shows the monthly closes of gold plotted as a percent of the price of the S&P. And each month you plot that reading. Okay. And when you do, you'll see that there's a trend line, gradual trend line going all the way back to 2014. So like 11, 12 years where you've bumped this line, bumped it. It's a super clear structure, not on a price chart, but on a relative performance chart. Gold broke through that in November, meaning gold performance broke through this resistance level it had with the S&P, where it had been confined, been basically going sideways for 14 years or so, a dozen or so years. And finally it punched through this line in November. Well, where was gold in November? $4,200.
Yeah.
Okay. November. Okay, let's start the clock in December because the breakout was the close of November. December, January, now February. 3 months later, we're $1,000 higher in gold net price. And the S&P is unchanged from where it was 3 months ago. Okay, so when these spreads break out, it often does not just signal, oh, one's going to do better than the other. But if the dynamics of that breakout are so clear as this chart is, and it's fresh, you just broke through a dozen-year base. Anybody with a crayon could plot the line. You just broke out a few months ago. This is not ending. This is something that's just beginning. And the initial price response to that spread breakout was $1,000 gain in gold, and S&P sitting there kissing itself. Okay? Wow. In other words, the spread breakout yielded a massive price surge. At the same time that happened, there's another spread chart. Well, I want to get to another one first. This is one that hasn't broken out yet. This is the really important one right now as far as I'm concerned about February, March. Okay. XAU index goes back into the 1980s. It's the Gold Silver Miners Index, Philadelphia. Gold Silver Miners Index.
Gold Bug Index, or whatever they call it.
XAU. Okay.
Yeah.
And if you plot it in relation to an ounce of gold, we divide the price of XAU in an ounce of gold, go back to the 1980s, and you'll see that on the left side of that chart, it oscillated in a range for decades with lows about 17.5 to 18%, meaning XAU would drop down to that relative value to gold, and highs above 30%. So if you look at that range and sort of divide it in half, you'd say, well, it lived on either side of about 25% of an ounce of gold. XAU expresses an ounce of gold. It collapsed in that bear market in 2015, got all the way down to 4%. In other words, the miners used to be worth 25% of an ounce of gold. Then they went to 4%. Okay, now what are they going to do? Go to zero? Okay, right. Screw your head on. Okay. Since then, that spread has lived in a range, perfect little box, for a dozen years plus, with highs at the same level. Every time it goes up to like over 8%, it gets knocked back down a bit. It doesn't go back to that 4% level. No, it didn't. It left that alone, but still lived in a range. You're now with 1 day left in the month. If you close tomorrow where the spread is right now, you're going to break out of that massive spread range. Similar to that line we broke out of, where gold broke out over the S&P, okay, November, and shot up $1,000. Even in the pullback, it's up $1,000 in price. Not just beating the S&P, but also a surge in gold. Well, here the gold and silver miners relative to gold are saying, I'm back. I'm reborn.
Yeah.
And I'm still at 8.7% of the price of gold compared to lows that were 17, 18%. In other words, when you look at that chart, if you broke out of that base and ran up to the bottom end of the multi-decade prior range of reality,
right,
you'd more than double the current relative value of the gold miners to gold. So wake up. Something's just beginning. You don't break that spread out and top the market. Okay.